All investing is subject to market risk, including the loss of principal. Past performance is not a guarantee of future results, and there is no guarantee any investment strategy will achieve its objectives. This information is provided for illustrative purposes only and is not a prediction, projection, or guarantee of future performance. This podcast is provided for general and educational purposes only and is not intended to constitute legal, tax, securities, or investment advice or recommended course of action in any given situation. All opinions and views constitute our judgments as of the date of production and are subject to change at any time without notice. Welcome back to the Dakota Studios. Today we are welcomed by a very distinguished guest, Brad Case from Middleburg. Brad, thank you for being with us.
Oh, I'm really happy to be here.
Brad Case is the chief economist for Middleburg, providing analytical support for C-level buy, sell, develop, and market-focused tactical decisions. Dr. Case has researched residential and non-residential real estate markets domestically and globally for more than 30 years. Prior to Middleburg, he worked as an economist for Fannie Mae, Nareit, and the Federal Reserve Board. His research encompasses a range of topics, including accurate measurement of appreciation and property values and the length of the real estate market cycle. Dr. Case holds patents as the co-inventor of the FTSE Nareit Pure Property Index methodology and the backward-forward trading contract, and has been a frequent speaker at real estate and investment conferences. Dr. Case earned degrees from Williams College and the University of California at Berkeley, and his PhD in economics at Yale University, where he worked with Nobel Prize-winning economist Robert Shiller. We're very excited. It's not often we get to speak with a distinguished economist that's on staff at a very notable real estate firm. You have a really interesting resume that we just walked through. Thank you and for joining us.
Oh, it's my pleasure. And it's great to be in this city. Wonderful, wonderful city.
We're going to be talking a lot today about Middleburg as a firm too, and just what you're seeing in the market today, in the real estate market specifically. But just to level set for our viewers today, I'd like to start with just kind of a broader overview of the firm and kind of the structure of Middleburg more broadly. But Middleburg's been operating for over 20 years, focused on the multifamily housing sector specifically. How has your mission evolved since your founding in 2004?
Yeah, when we started, it was a fairly basic idea, investing in communities where we thought that there was an opportunity to add value, either because we were purchasing a community that was undervalued for whatever reason, or because we were purchasing it at its value and adding value to that. But there was an early, very strong test, which was the real estate market downturn that started in 2007. Not just real estate market downturn, but the very severe recession that started in 2007, and really in the housing market lasted until 2012. So getting through that was a real accomplishment. Since then, what the company has done is really broadened by looking for places where we could add value and also prevent value from evaporating. And for that reason, we're now soup to nuts. We do everything from searching for pieces of land and acquiring them and developing new properties. Building them, that's a very important piece of preventing value from evaporating, is controlling the construction process entirely, and then operating the finished buildings. And we also occasionally invest in other properties. We don't typically do either third-party construction or third-party property management. It happens from time to time, typically because we are also investing in some other way in that community, or because we used to be invested in that community. Maybe we owned it and now we've sold the community, but we still manage it, things like that. So we are soup to nuts, but as I said, not sort of third party operating for other people in the business.
And as you mentioned, over that 20-year period, you've been through many multiple market cycles, different interest rate regimes. So you have been, invested in a number of different property types too. So you've seen a lot of different cycles. So that having the benefit of that behind you and a lot of the learnings from that to build up a platform to benefit today.
Yeah, and in fact, you mentioned my background as an economist, and I think it's worth pointing out how rare that is. And the reason that Middleburg Communities decided to hire an economist, and when I say an economist, there are other companies who will have somebody whose title is economist because they took an undergraduate class. As you mentioned, I have a PhD from a fairly top program. The difference there, the reason there, is that Middleburg believes that there is real value to be had, not just in what we're currently doing, but in deciding how to expand it by applying high-level empirical analytical techniques in an industry that just doesn't use them very much. And so, for example, over the next several years, I do expect our footprint to expand. And we certainly do analysis of the different types of rental housing property that we do or think about doing, so that when we're taking a step to expand what we're doing, it's not just sort of rubbing our belly and saying, how about this? It's thinking very carefully, is this the right way to create more value?
And we'll get into that analytical approach a little bit further within the investment process too. But you mentioned an important point too, you're an integrated platform, research, development, construction, management, and investment all under one roof. How does that vertical integration give you an edge in the market today?
Oh, sure. One of the things that takes a lot of time for a developer is finding pieces of land, doing the initial underwriting, figure out whether they're going to pencil out into a successful project, and then digging deeper and deeper and deeper. All of that happens among people who are talking to each other every single day. And so one of the things that we try to avoid is looking for pieces of land where it just isn't likely that we'll find something worth developing. And so the idea is that there is a funnel. We'll look at a lot of pieces of land to get one or a small number that really turn into successful projects. But the range of pieces of land that we start by looking at is going to be much smaller because we're targeting our efforts. And we're targeting our efforts based on the research. But then one of the very important parts, in the early underwriting is, what do we expect the rents to be? Well, we could look at what other people are charging, but we have to figure out whether our properties would get that kind of rents. And that's just another step that we try to make both more accurate and more efficient. And then another piece of it is the pre-construction. What are the special considerations at this site that's going to make it more or less costly to develop, or faster or slower than usual? And again, that's talking to somebody that we see face to face every day, rather than calling up, somebody in a construction company and saying, "Will you go and take a look at this piece of land and tell us what you think?"
So, based on your research today, where do you see the strongest demand drivers across multifamily and build-to-rent housing?
So, our footprint really is the Mid-Atlantic and Southeast part of the country, basically from Maryland to Florida, Tennessee, Alabama, and we have been active in Texas, and I expect we will be again soon. That's not an accident. We don't look for good opportunities in a part of the country we're comfortable with. We're comfortable with that part of the country because the demand growth is so strong there. Our business model focuses on what we call middle market Class A. So we're not typically involved with luxury, high rise. We look for what we call attainable housing, which is usually different from what is often talked about as affordable housing, which is subsidized. We do some of that as well, but it's not our bread and butter. And so what we're looking for is growth in the number of employed young adult households. And our basic two types of rental housing are, garden-style multifamily communities and build-to-rent single-family communities, rental housing communities. And the difference there is simply a little bit of difference in the age of the renters and in the size of the household. But in both cases, we're looking for growth in the employed young adult population. And so when we go to the Southeast, it's not because people are retiring to Florida. That doesn't interest us. What interests us is the fact that so many people are moving to North Carolina, South Carolina, Virginia, Florida, Tennessee, Alabama for jobs, for good jobs. And part of that is because of the employers are moving to those places as well.
And in those states specifically, are there particular markets in those states that you're focused on?
Oh, absolutely. Again, we look for, let me answer that in two parts. We look for markets with growth in that employed young adult middle market category. And within particular locations, particular markets, we look for the locations where that is happening. So, for example, Charlotte, Raleigh, Durham in North Carolina, that's a very strong, very important growth market for our intended population of renters. But not every location in those is going to be good. And in fact, what you saw a few years ago when money was very easy to get is a lot of development happening in fairly poor locations of those growth markets. So we're not scared away from those markets. We love those markets. but we are certainly going to avoid the kinds of places where people were looking at just because they could get easy money and it didn't really matter where they bought a piece of land. We're looking for a good piece of land in each of those markets. And sometimes it'll take us to a market that other people aren't considering. So it's not just that we restrict ourselves to certain markets. We're looking for good pieces of land, but we are targeting where we look for them.
We talked a little bit from the demographic perspective about affordability. How has renter demand in the middle market segment evolved, especially given kinds of affordability challenges we keep hearing about?
Yeah. So the most important aspect of the evolution of the renter housing market is the increase in what we call the rentership rate, which is the number of adults who form their own households by either buying a house or renting an apartment, renting housing of some sort. And that household formation has been on a tremendous upswing since 2014. And most people aren't really aware of either of the fact that is happening or just how much it drives demand for rental housing. Now, when we look at affordability in the owner-occupied side of the market, what that's telling people is you're ready to get your own housing unit? Think again if you were thinking about buying, because it's not really a good time to buy. Let's look at the possibilities in the rental housing part of the market. And so that's where we come in. Some of those people really do want 4 walls and some grass outside. Those are the people who are coming us for our build-to-rent, single-family rental housing communities. Other people are looking for the more traditional multifamily community where they're seeing their friends around the pool at the center of the community. We have that as well. So we are taking advantage of both the increase in the number of people who are forming their own households and signing their own leases, and the fact that those of them who would have been thinking about buying are thinking less about buying because it just doesn't seem to make sense.
And we talked a little about this earlier, but when evaluating the new markets, what indicators are most predictive of long-term success? So we talked a little bit about job growth and new jobs opening up in these markets, but are there things like supply constraints or migration patterns or something else? Was there any one in particular that you weight heavier?
No, there are several things that we're looking at. So we do look for job growth, and we pay attention to the types of jobs that are growing there. Investment banking, growth in investment banking, that's not really our market. That's going to go to downtown Miami in a 30-story high-rise luxury place. It's not really what we do. Growth in the number of teachers and people who work at hospitals, and sort of that middle market professional or semi-professional employee. That's great for us. So we look for when a company from the Northeast or from the Midwest gets tired of the cost of doing business in that part of the country and gets tired of the weather and looks down south and says, you know what, now it looks pretty appealing, both in terms of a cost of doing business and in terms of a living amenities point of view, then who's going to come with them? Which of their employees has been waiting for that opportunity to move to a better place? So that's the employment growth piece of it. But that also explains a lot of the simply young adult population migration, and that's really the key. When we look for pieces of land in a growing market, we're looking for places from which those employed individuals can fairly easily commute to whatever job they have in mind. So we're not typically going to be on the far outskirts. We're also not typically going to be right downtown. Sometimes when we do an indirect investment, that's where it'll be. But for the things that we are developing and building, they tend to be in that sort of inner suburban area where it's easy to get to jobs. And then we look for living amenities. You want a nice coffee shop nearby. You certainly want a nice grocery store nearby. We look for amenities like that to make sure that people don't feel isolated once they get to the community.
You spoke about this build-to-rent segment. What's sort of the structural drivers behind this part of the market?
Yeah, build-to-rent it's very important to understand what we mean by that. There are 3 types of single-family rental housing out there. One is what we call scattered site. Somebody has bought up a bunch of houses and rents them out and then drives around to fix things here and there. That turns out to be a very inefficient model, and so I think that is not a growth part of the industry. The second is builders who built a bunch of things for people to buy. It's not a community, it's just a collection of single-family houses together that they're hoping to sell, but they can't sell because it's too expensive. People don't want to buy that anymore. And so what they do is they start renting it, and they say, see, we've got single-family rental. That's not a single-family rental community. It's a single-family house that's for rent near other single-family houses. What we build, and what we mean by build to rent, is a community that has all of the same amenities that you would get from a good garden apartment community. It has the swimming pool, the gym, the maybe on-site retail, things like that. But everybody around you is there because they want to be in a single-family house. And so we tend to get a couple of real advantages there. One is we tend to get renters who are a little bit older, who are at the age where otherwise they would have been looking to buy, but they're not. They may have children, and they're more mature, so they're going to be better neighbors. And from our point of view, they're not going to damage the place. One of the great things from our point of view is that they tend to stay longer. They love this idea of having four walls and grass and those community amenities, and not being locked in with a 7% broker's fee if they want to move to get a better job somewhere else. What's important in driving the demand for build-to-rent housing is the fact that it simply hasn't been available before. So it used to be you really had to choose between traditional multifamily living or buying. If you were going to rent a single-family house, it was going to be from the idiot who lived a couple of blocks away who might or might not fix the toilet when it overflowed. In our communities, you're getting the same professional management that you would get at any other sort of, as I say, middle market Class A rental housing community.
And it's all because this really didn't exist many years ago.
It did not exist. So it is an option that people wanted and didn't have.
And this demographic of tenant wasn't necessarily buying in yet because the other people that are renting, these were younger renters that were already in these buildings occupying them. This is a new asset class where there might be people that are taking care of their places more, staying in them longer.
Absolutely.
Not ready necessarily to move into maybe a senior living facility, but not ready to move into a home.
Not nearly ready to move into senior living. We're talking about people who are 35.
Yeah.
The renters in the garden apartments maybe in their late 20s.
Okay.
But the renters in the BTR are more typically going to be in their 30s. And yes, that means they're better neighbors. And so you don't see people saying, I need to get out of this place because the guy next to me is so unpleasant. It just doesn't happen so much. And that's part of the reason that people stay there longer.
So switching gears a bit to talk about the firm's investment process. So a point of emphasis for Middleburg is the off-market land acquisitions and the proprietary research that you provide. How do you identify which markets and sites are most attractive?
Oh, it's very, very important. And actually, from my point of view as an economist, it's been very fulfilling. We have developed a very sophisticated model to help us target where to look for pieces of land. And by that, as you say, we're talking about off-market opportunities. So we're telling our land ac team, go here, find the people who own the land, and regardless of whether they've said they want to sell, talk to them about selling to us, because we think that's a good place for us to build a new community. And how do we do that? Well, it's kind of a both bottom-up and top-to-bottom way of looking at it. Our part of the country is divided into 59,000 of what are called census block groups. We collect data individually on every one of those census block groups. And it's everything from what do the households look like in that area in terms of their size, age, income, that sort of thing. And what are the amenities that exist in that area? We actually have a very sophisticated nonlinear machine learning model, what's similar to what some people call AI. And we use that model to say, given the characteristics of this area, how likely is it that we think we would be able to find a piece of land there that would turn into a successful development for us? And so it's not we're looking there because there's land available. It's not we're looking there because there are high incomes or high rents, or because somebody could develop a spectacular high-rise. It's would we be successful at what we do? And that's actually a very important continuing theme for us. We have capabilities that we don't exercise because we have a very strongly defined sense of what we're especially good at. And so when we are talking about expanding the company, we're talking about expanding in ways that make use of both our analytical capabilities and our capabilities in terms of design and construction and management and things like that. So our machine learning model gives us, for each of these 59,000 areas, an estimate of how likely it is that we will be successful in that area. And then the other piece of it is the market. That's where we're looking at growth in the young adult population and employment and things like that. And we're saying, all right, there are 123 markets in our part of the country. Let's choose the 10 or 20 that are worth looking at. It's not that there aren't going to be individual pieces of land somewhere else, but we're not going to spend our time looking for them, because these are the markets where we are quite confident that we'll be able to find good pieces of land to develop.
Are there certain mistakes or oversights that you see other developers make in their market analysis that you make sure that Middleburg is careful to avoid?
Oh, absolutely. So I would say maybe there are 2 or 3 big ones. One of them is simply the idea that, what's really important in real estate is not looking at the data, but my gut. I walk around and I say, wow, this is a great place. Let me buy a piece of land and develop it. The fact that you like it doesn't mean it's going to be successful for you and your investors. Another thing that's similar to that is that there are real estate developers who tend to fall in love with what they've developed and built. One of the things that really attracted me to working with Middleburg communities is that they identified a few years ago that it was a especially good time to sell their assets. And so they sold everything they owned with just one exception. They weren't in love with what they had built. They were in love with the idea of turning what they had built into a very good, very successful investment. There are two reasons to be in real estate, right? One is to impress your friends. The other is to make money. Yep. And Middleburg is in the business of making money for its investors. And so those are some of the most important mistakes to avoid. But a third is simply the process of, the idea that you're going to hear about a piece of land from your buddy who's a broker. Well, you already know that you're going to get false data from, even though that person is your buddy, doesn't mean they're going to give you a good evaluation of the possibilities in that location. You have to be able to evaluate it on your own. And so that's sort of the third mistake that we try to avoid is buying somebody else's story rather than doing our own careful research at the location level.
It's almost like buying and selling stocks in a way, taking out that emotional component.
Oh, yeah. Don't buy a stock because somebody just touted it on TV.
Yeah. That's
when you should be selling it. Buy the piece of land that you understand is going to be important and other people don't. And most importantly, I think, buy the piece of land when other people don't have the opportunity to buy it. And so I mentioned before that there are quite a few places where a rental housing community may have been built in, let's say it's a growth market, but in a lousy area of that growth market. And why was it built there? Because money was available to that builder. When interest rates go up or when something else happens so that money is less available, whether we're talking about debt or equity capital, then lots of would-be developers are just swept out of the business altogether. And the ones who are left are the ones who are not going to get caught up in that, easy money, let's just build anywhere. And that means that they have the capabilities to be active in the best parts of the market when those best parts of the market become available. So don't get caught up in the euphoria of the market. Be disciplined so that you're able to take advantage when the non-disciplined people get swept out.
So Middleburg also allocates capital through their credit and co-GP strategies. So I'm just curious how the team's research guides decisions about where and when to allocate capital to those.
Yeah, there are a couple of ways. One, it's important to recognize, I mentioned that our bread and butter is what we call middle market Class A, multifamily or single family build-to-rent communities. When we are providing capital to a different developer, in some cases it's because they have a good opportunity, and that's not an opportunity that we would pursue because it's not our sweet spot.
Yep.
But very importantly, when we are providing capital for what we call an indirect investment, it's typically because we have something to offer besides just capital. They can get capital from anywhere. Mm-hmm. But they may need some of our expertise. Maybe it's at the early stages of setting up the development. Maybe they would like to use our design, the design that we have developed for our build-to-rent communities or our garden apartment communities. maybe they would like to use our construction expertise. So we're typically both providing capital for them, to fill some gap that they have, and providing expertise that makes their development more successful. And so sometimes what we are doing with somebody else is not our sweet spot type of development, but in every case, we are still applying our analytical capabilities to evaluate whether we think their development is going to be successful. And again, it's not just, talking to somebody and saying, you have a good story, let me finance it. That's not a good way to make money in real estate. The good way to make money in real estate is to say, tell me your story, now let me go and investigate it. Now let me do my own analytical work and figure out whether I think that's a good place to develop, whether you're going to be developing the kind of stuff that we do, or whether you're going to be developing the kind of stuff that we typically don't do.
Could you dig a little bit deeper into how you evaluate these potential partner GPs, and what are certain things you look for that give you confidence that they can execute?
Well, so in my role as an economist, I'm not looking at the GP. I'm not looking at their execution. That's other people in my company are doing exactly that. What I am doing is saying, if this were our project, if this were the kind of project that we were going to do, how would I evaluate that? Do I think it would be successful for us? So that's one hurdle. The other hurdle is, do we think that these people are going to be successful in executing that project? So you end up having sort of two levels of defense against making a bad investment. And when we're doing our own investment, that second level, when you're the execution, we're very confident in that. We have so much practice in executing with our designs on, using our construction capabilities, so that's not an issue. But in both cases, you have to start with that underlying empirical research.
Got it. And then turning to the credit side of the house, Middleburg's credit investment program's been going on since 2018. Any lessons learned there, and anything there that is guiding your forward view?
Well, I think probably the most important lesson is the targeting one. You can find credit opportunities anywhere in the world, and certainly anywhere in the United States. And in terms of our empirical analytical capabilities, we can do that analysis anywhere, but it's much more difficult to evaluate the execution of by a third party in that you don't have that much familiarity with, in a market with which you don't have that much familiarity. So we certainly have great familiarity with our core markets. We have development partners located in all of our core markets, and we've chosen them as our partners because of their very good expertise with the locational amenities in that market that maybe people aren't entirely aware of, or the permitting process in that market. They have great local familiarity. And if we're going to be working with somebody who's outside of our core market, we need to be able to get a similar level of confidence in their strengths in terms of the local market.
Turning to risk management now, from a macroeconomic perspective, what are the biggest risks you're watching right now for multifamily investors? So that could be interest rates, construction costs, maybe something less obvious.
Yeah, so that's a very important part of my job is to support the C-level decision making, not just in terms of where to develop or where to look for acquisition opportunities or credit financing opportunities, but also when to focus more on one part of the business than on another. So, for example, I mentioned that we do some sort of lower cost housing, whether it's what we call big A affordable or not. In some situations, that's because of where we are in the market cycle. When we're thinking about acquiring properties, which we do, or selling properties, which we do, that's typically about sort of where we are in the market cycle. And so we want to have better information than other investors in real estate. And so if other investors in real estate are forming their judgments based on either watching television or watching YouTube or talking to people at a cocktail party, we're looking at the underlying data and forming an opinion. So, for example, one of the things that I do 5 times a month is update a model that helps us understand what are the risks of recession. And what is that likely to do with interest rates? And not just the interest rates that we hear about that are set by the Federal Open Market Committee, but what's going to happen at the longer end of the yield curve, which is where our cost of capital is more likely to be determined. And so we have that in-house capability of looking at that every day, as I said, 5 times a month we update that model, but every day we're looking at other developments. And so the CEO or the CIO has an opportunity to say, Brad, what's going to happen as a result of this? Or if we're thinking about locking in an interest rate, going a forward interest rate, is that the right thing to do? So we have to understand the macroeconomic risks to do that. In terms of what are the biggest risks, well, a lot of people will say the biggest risk is higher interest rates. We don't think of that as much of a risk because of the fact that we know we will be continuing to operate within any kind of an interest rate environment. Other people will not. So if interest rates go higher or remain high, that hurts other people a lot more than it hurts us. Would we like to have lower interest rates? Yeah, if it didn't mean that people who didn't know what they were doing were jumping into the market. But they do. So we would rather operate where it's not easy for people who don't know what they're doing to get their hands on money and mess things up for the rest of us.
And to dig a little bit deeper, how do you stress test these assumptions like rent growth, occupancy, financing availability, especially when market conditions are very fluid?
Yeah. So one of the important empirical capabilities that we have is a model that we can use to figure out what the rent would be for on a day-to-day basis, every day, for any of our properties, any location in which we're thinking about developing a property, and anybody else's property. And think of what that gives us. It gives us a really good way to underwrite our potential projects right at the beginning. We don't have to look at what other people are getting in that market. We can look at what we would be getting in that market for our units. But on top of that, we're looking at other people and saying, this property looks like it's poorly managed. Given the location of that property, given its design and its amenities, here's how much they should be getting. Here's how much they are getting. There's something wrong with their management of that property. Now, if I then look at every other property owned by the same organization, which I've done, I'd say here's an organization that seems as though it is managing its properties poorly in 8 different locations, all of which seem interesting to us. Let's go talk to them about buying their portfolio. So that's, again, we're not looking at on-market offerings. We're not going to a broker and saying what's available for us to buy. We're saying here's an organization that doesn't realize how much more valuable their properties could be if somebody who knew what they were doing were the owner of those properties. Let's take advantage of that. From a macroeconomic environment, yes, we're looking at risks, but we're also very much looking at opportunities. And some of those opportunities are created by the fact that most people in this industry don't really know what they're doing.
And one more from me before I pass back to Chris, but sort of given these rising financing costs, how has your outlook and the firm's outlook for returns and hurdle rates shifted, and how do you convey that to your partners and investors?
Yeah, well, it's much more difficult.
Yeah.
I mean, that's really the fundamental thing that has changed is we go out looking for debt capital. That's not a problem. I mean, in the past there have been times when getting debt capital has required more work. Now it's getting equity capital that requires more work, and that's because of the interest rate environment. But again, we're happy with the fact that everybody else is having that kind of trouble as well. Our capital team is really quite good at identifying, sort of making a match between a community that we are either doing or thinking about doing, and a source of funds that, where that community fits exactly what they're hoping to accomplish. So we make those matches and we take it out to people. And so, it's not going to be the first 5 people that we talk to that are going to provide the capital. It's going to require more work because of that financing environment. But as I said, what's great is that everybody else is having more trouble than we are.
And just to kind of add on to that point that you were making there too, if you look out the next, call it 5 years, what does your research sort of suggest, from a supply-demand perspective for multifamily?
Very, very important to understand that. We're always comparing growth in demand with growth in supply, but people don't tend to realize that that supply shifts much more quickly than demand does. It's not that it has to be that way, but it is that way. So during COVID, what we saw was a lot of people, first of all, moved from other parts of the country into our part of the country. On top of that, they split up, instead of 2 people in one household, two like fraternity brothers in one housing unit. They became people in two different housing units. So that increases the demand for rental housing. It also increases how much space they want, which is another driver of the demand for BTR. Some people who would have been happy in a rental housing unit simply want more square footage, and so they're going to move into one of our BTR communities. Those demand drivers tend to be long cycles. There was that surge during COVID, and that was followed up by a surge in supply, and we were part of that. Rents have gone way up. People simply want more rental housing than is available. Let's provide it. The supply is dropping off a cliff now. That supply surge that we saw for 2 years is over. And so in an important growth market like Charlotte or Raleigh, what we've seen, and it's actually fairly gratifying, is that there was that big surge in supply, and now people are nervous about how much supply has gone into Charlotte. But with our analytical capabilities, we can say, yeah, but you're counting this place way out in the middle of nowhere, which I visited. I'm thinking of one in particular. You can hardly even count that as part of the Charlotte metro area. Look at what we're building, and it's part of the same metro area, but it's in a place that's underserved. So we're coming up with estimates of supply growth and demand growth at a very local level, so that we're not just saying Charlotte. We're saying this submarket in Charlotte and this part of that submarket. And we're not just saying, I feel good because I go in there and I don't see any cranes. That's not very helpful. What's really important is what are the things that are likely to be developed over the next few years, and what we're seeing is that is falling off a cliff.
And so in aggregate, that in the markets that you're seeing at a local level, that with that supply dropping off a cliff, the demand's still supportive.
Oh yeah. The demand is not falling behind. That I mentioned the important role of household formation, and as I said, that started in 2014. A lot of people don't realize how strong a driver that is. After World War II, there was a tremendous growth in the number of households in this country. People who had been living together, maybe with their parents, went and got their own place, whether it was rental or owner-occupied. So a tremendous growth in household formation. What we've seen over the last 10 years has been more rapid than that. And that is just stunning. It's just amazing how strong household formation has been over the last decade. And it's not letting up.
How does Middleburg's focus on affordability fit kind of in this broader picture that's going on today?
Yeah, so as I said, we're a lot of developers, they're in the business because they think they have a shot at developing a luxury apartment, on the waterfront or something like that. That's like buying a lottery ticket. Yeah, if it works, you make a lot of money. Most times it doesn't work. We're in the business of building housing every single year. And so when we're looking at our middle market class A, our teachers and police officers and nurses and that fully employed, well-paid middle part of the market, we're looking at people whose ability to pay rent is not seasonal. It's not gonna end suddenly. They're not working for a company that's gonna close up shop. That's what they left when they moved down here from Ohio or wherever they moved from. They moved to a place where employment was gonna be more stable. So we're looking for people for whom the vagaries of different parts of the market are not going to be an issue. And that's part of the reason we're not interested in the luxury part of the market, because it is so much more vagrant.
Yeah. And so just again, looking ahead, if you were to make one bold prediction, just looking out, say, over to 2030 on the multifamily market, what would be that bold prediction be?
Yeah, the bold prediction is a big increase in the rentership rate. People talk about the homeownership rate. The rentership rate is simply the opposite of that. People who don't buy a house, rent a house. And what we're seeing is, number one, a big growth in the population of young adults, a big growth in the population of people who are most likely to be renters anyway. On top of that, tremendous affordability issues in the owner-occupied side of the market that aren't going to go away. Even if the Fed reduces short-term interest rates, that doesn't mean mortgage interest rates will go down. In fact, there's a lot of likelihood that they'll go up. So the affordability on the owner-occupied side of the market is only going to continue helping us. And then, as I said, the build-to-rent part of the market, which is opening at an option for those people that they never had before. So my bold prediction is you're going to see tremendous growth in the number of people who will be renters, some of whom who would otherwise have become owners but won't. And as a result, you'll have a larger share of the population renting, whether it's in your traditional multifamily or whether it's in your build-to-rent, single-family rental communities. That's the important part of my prediction going forward.
Well, you certainly make a compelling case. Brad, thank you so much for joining us today. We really appreciate you sharing your insights, both Middleburg's pragmatic investment approach in focus, but also through your economic lens and how you invest through the multifamily investment market today.
Well, I'm very proud of what we've done, so thanks for giving me an opportunity to talk with you about it.
Absolutely. Well, thank you all for joining us today, and have a great day.